Grid battery storage added a record 200 gigawatt-hours globally last year. That's 13 times what was deployed just 5 years ago. And here's what happened to the companies trying to serve that market. In this episode, we answer 3 questions. Why is grid storage growing faster than almost any market in energy, and why did it take this long? Why do most companies in this space keep destroying capital, while one prints money at a margin that rivals software? And where should US investors actually look for real exposure to this theme? Let's start with the market itself. In 2019, the world installed 8 gigawatt-hours of grid-scale battery storage. By 2024, that number hit 200 gigawatt-hours. A 25-fold increase in 5 years. What changed? 3 things converged. Here's what makes this industry genuinely strange. Take 5 companies. They all sell large-scale battery systems. They all source lithium iron phosphate cells. They all sell to the same utilities, the same project developers, the same industrial customers. The results look nothing alike. Tesla's energy segment, $10.1 billion in revenue, 26% gross margin. Sungrow, estimated $5 billion. Tesla's energy segment is the most underdiscussed $10 billion business in public markets. Most analysts model Tesla as a car company. But in 2024, the energy division, Fluence story is about as close as this industry gets to a turnaround. The company went public in October 2021 at an all-time high of $37.61 per share. Then came 2 years of rising interest rates, mounting losses, and a stock that fell all the way to $3. 2 Chinese companies sit at the center of this market, and neither is easily accessible to US investors. BYD installed 40 gigawatt-hours of energy storage globally in 2024, representing 13% of the world market. Its key structural advantage is the same one that defines its EV business: in-house LFP cell manufacturing. BYD makes the cell, packs it, integrates it, and ships it as a complete system. The margin stays inside the company at every step. US investors can access BYD through BYDDY, an over-the-counter ADR that tracks the Hong Kong-listed shares. It's not a pure energy storage play, the EV business dominates, but it's the most liquid way to hold Chinese battery. Let's be direct about what happened to the companies that didn't make it. Powin was the 3rd largest BESS integrator in North America in 2024. It deployed meaningful gigawatt-hours, had a real project pipeline, and was a credible competitor to Tesla and Sungrow in the US market. Then it filed for bankruptcy and was acquired by FlexGen. The root cause wasn't a lack of demand. It was margin. Rapid expansion into large projects, hardware costs that couldn't be passed through to. To understand who wins in energy storage, you have to trace where the margin actually accumulates in the value chain. Lithium mining sits at the top, but margins are volatile and cyclical. Cell manufacturing, where CATL and BYD dominate, runs 10 to 15% gross margin under normal conditions, with the advantage of massive scale. System integration, where most Western companies compete, operates at 6 to 13%. It's the most competitive layer, with the most commoditized product and the fewest defensible advantages. Software and services, in theory, offer 30 to 50% margins. But as Stem demonstrated, you need hardware volume to get there. The software layer is valuable only if you're already managing a large installed base. Project development and utility ownership, NextEra, AES, and similar. The competitive map tells the story cleanly. Tesla sits at number 1 globally with 15% market share. Sungrow is right behind at 14%. CRRC, a Chinese state-owned company primarily known for building rail rolling stock, holds 8%. BYD controls 13% through its installations business. Of the top 10 BESS integrators globally, 7 are headquartered in China. In the US specifically, Tesla holds 39% of the North American market for the 3rd consecutive year. Sungrow's US share dropped from 17% to 10%, driven by tariffs and supply chain scrutiny. Powin held the 3rd spot before its bankruptcy. One data point captures the geopolitical dynamics. Chinese companies' North American market share fell from 23% to 16%. Let me give you my honest read on how to think about US exposure to this theme. Tier 1 is where I'd start. Tesla's energy segment is real, profitable, and growing at triple digits. The problem is that you buy the whole company, and in 2024, the car business faced serious pressure. In my view, if you believe the energy segment continues compounding, Tesla is where the structural advantage lives. The 26% margin at scale is not an accident. It reflects genuine vertical integration that competitors cannot replicate quickly. BYD through BYD gives you exposure to China's full battery stack, cells, systems, and EVs. It's not a pure storage play, but it's the most liquid proxy for Chinese battery dominance. The ADR trades at a discount to the Hong Kong listing and carries currency and geopolitical risk. Tier 2 is worth watching. Fluence has turned the corner on profitability. A $4.5 billion backlog means 18 months of revenue is already contracted. The stock at $15 is 60% below its IPO high. The recovery from $346 to here reflects real operational improvement. But the structural disadvantage, no cell manufacturing, no IRA credits, hasn't changed. In my view, Fluence is a viable company, not a high-conviction position. One to avoid clearly, Stem. The software thesis didn't survive contact with hardware economics. Bankruptcy probability remains elevated. The reverse split is a warning sign, not a floor. Before we close, 3 signals worth watching over the next 12 to 18 months. Watch Tesla's Shanghai Megapack production ramp. The factory began output in early 2025. If quarterly deployment exceeds 10 gigawatt-hours from Shanghai alone, Tesla's global lead over Sungrow widens materially and cost per kilowatt-hour likely falls, protecting margin even as pricing competes. Watch IRA credit policy. Tesla received $756 million in Section 45X manufacturing credits in 2024. Any revision to that credit structure, rollback, cap, or eligibility change flows directly to Tesla Energy's gross margin. This is the single largest policy risk in the sector. Watch Chinese companies' North American market share. The drop from 23% to 16% in 2024 reflects tariff pressure and geopolitical friction. If that trend continues or accelerates, US-based integrators, Fluence, new entrants, utilities building in-house, gain ground. If Chinese companies find workarounds through US partnerships or domestic manufacturing, the competitive pressure resumes. My most likely path over the next 2 years, Tesla's energy segment continues growing, gradually becoming impossible for analysts to ignore inside the Tesla valuation. Fluence stabilizes around 12 to 15% margin but doesn't break out without a cell manufacturing advantage. The rest of the field consolidates further. I'm Big Z, follow me, see you in the next deep dive.